When you're building a mergers and acquisitions deal team from buy side specifically, there's three types of professionals that you absolutely need. Two are professionals, one can be an operational team member. So who are these people? Number one, from your professional team, you need a lawyer and you need an accountant. Now, it's very important that you understand a few things with regards to these lawyers and these accountants, is that this lawyer and this accountant, they have to have mergers and acquisitions experience. It's absolutely crucial that they have M&A experience, and especially from acquisition side, from buy side. The reason why you need to have M&A experience, look, there's lawyers and accountants who specialize in certain things. So if you have a lawyer who is a property conveyancer, they have a different skill set versus someone who knows how to do acquisitions of businesses. So the documents which are used are different. In properties, the documents that are used in businesses are different. And of course, I think it goes without saying, you can't use like an inheritance lawyer to do buy-side M&A transactions. That's just without saying. Now, if for example you're using a very big law firm to do an acquisition, maybe you've been dealing with the inheritance department. They might have an acquisition department within that huge law firm, but you need to find out. You need to speak to these people, to these lawyers, and say that, have you done acquisitions? And have you done acquisitions? When was the last time you done an acquisition? What kind of documents that you use? You need to hear the words like SPA and APA. And you need to hear that they're able to add the protections in, the warranties and so on, that will protect you as a buyer. Now, when you're finding a lawyer or an accountant, you need to go out and you need to speak to multiple lawyers and multiple accountants. And that's when you're going to be able to pick the best ones. Now, it's really also important to understand that you have to find the lawyer and the accountant who has worked on your deal size as well. In the Introduction to Merger and Acquisition Strategy Masterclass, I go through the different sizes of businesses. You've got micro businesses, you've got small businesses, and you've got mid-market businesses. Now, of course, if for example, let's say you're doing small business acquisitions that are doing of businesses that are doing between 2 million and 10 million in revenue, if you're going to an upper middle market lawyer who's done transactions in the upper middle market, the upper middle market is 100 million plus in revenue, 100 million to 500 million in revenue. They're going to be looking at completely different things. I remember when I was interviewing lawyers to do my first transaction was just shy of $1 million in revenue. They were using documents, these 70-page documents so that's basically middle market documents and this is a micro business really. It just didn't work. Now, we still got the transaction done, but after that transaction, I realized when I started speaking to other lawyers as well, that the document was just way too detailed. Majority of the warranties and the indemnities and the clauses that were in that document just wasn't required for a small business transaction. So, Warren Buffett and Charlie Munger, they really emphasize this point. Now, don't forget, Warren Buffett, when he's doing transactions, when he's buying businesses which are in the middle market, upper middle market range. That's where he's buying businesses. And he says that we spend such a small amount on our diligence, on our legal frameworks compared to other people. So they always give the example of private equity. They say that private equity, they spend like 2 million just in the first quarter of getting their deal done. But Warren Buffett, he said that we don't even spend that in 2 years. So they have a very, very small business because they keep things simple. And when you're in the small business and the lower middle market, so 50 million below, you just use simple documents. And that's enough to get the deal done. So that's why when you're speaking to the lawyers and you're speaking to the accountants, say, right, what size of transactions do you normally work on? Or what size of transactions have you worked on? If they turn around and say we worked on transactions which are 250 million in revenue plus, they're not the right person for you. Do they know people who have worked in the small business marketplace? Now, of course, if you're doing mid-market transactions, the upper middle market, you're doing 100 million plus transactions, then that's fine. You can use them. But if you're not, then you can't. Also, the people who are doing upper middle market transactions or these mid-market transactions, their fees are going to be so much higher, disproportionately higher. And we're going to talk about fees now as well. So let's talk about your lawyer and an accountant. Now, this accountant, by the way, is not going to be your accountant that does your taxes. It's not going to be your CFO for your business. It's going to be an external accountant who specializes in commercial due diligence. And when you speak to these guys, they're going to be charging you a fee. The best way to do these is to try to get a fixed fee. And you have to get deferred fees. Now, most professionals will work on deferred fees if they're confident that you can get a deal done. You know, it's really, you can smell the people. When I say smell the people, you can smell the people who are not confident, who can't get a deal done. You can smell them from a mile away. You can spot them from a mile away. Same way, the lawyers and accountants, they will spot what I call a pretender. They can spot a pretender from a mile away. So you need to be confident in the way that you're coming across and you're speaking to these people. Now, of course, if you're a business person, you've already got that confidence. You don't need to worry about it. If you're a high net worth individual, or if you're someone who's been around the block and you've done some transactions, and it doesn't mean that you've done transactions in mergers and acquisitions, maybe you purchased a few properties, or you've dealt with lawyers and accountants before, you will have that confidence. Great. And that's mainly the people that I'm talking to anyway. Business owners, you will have an easier time talking to lawyers and accountants because you've got your history of your business to say, right, I've done this and I'm going to acquire businesses. They will be more than happy to work on deferred fees for you. So deferred fees basically mean that they do the work and then you pay them after the work is done. Pay them after the work is done. And to be perfectly honest, if you have a business right now, then because some lawyers and some accountants, they want you to pay 50% up front. Ultimately, it's still going to be outstanding. Now, I know there's some people out there like Dan Pena, they talk about, they roll the one failed transaction to the next one. Yes, you can do that, of course. If you're a business owner, there's no point doing that. Just pay the fees and get it over and done with. Ultimately, you're going to have to pay the fees anyway at some point. So, but if you get it on deferred fees, it just takes that pressure off of you as a business owner or as an investor to be paying fees up front to be able to get a deal done. And the benefit of getting a fixed fee done on a fixed fee is that you know how much you're spending. Now, it's something that you have to think about. Even though we talk about fixed fees all the time, no lawyer, no accountant, nor me, no anyone, no professional in their right mind is going to do an unlimited amount of work for fixed fee. They're not going to do an unlimited amount of work for fixed fee. So what you have to kind of bake into the agreement, what the lawyer would bake into, because they're going to want you to charge you by hour, fractional fees, for example. You need to bake in there, like, for example, for 20,000, right? For 20K, you're going to do X amount of work. X amount of work. Of hours or whatever it may be. Yeah? Because look, these lawyers and these accountants, they've got customers everywhere. They've got clients everywhere. So why should they work for you unlimited for a fixed fee? That's something that you need to consider. But you need to work on deferred and fixed fees. So your lawyer and accountant must have M&A experience, and they must be have from buy side and also transaction size as well. Transaction size is your transaction size. Of course, if you're in the small business space, 2 million to 10 million, have they done small business transactions? If you're in lower middle market, have they done transactions from 5 million to 50 million? If you're in middle market, have they done transactions from 50 million to 100 million or 200 million? If they have, then great, use them. So that's your lawyer and accountant, which is your external professional team. Now, your lawyer is obviously checking the legal side of the business. Yes? They'll be checking the legal side of the business. And then the accountant is checking the financial side of the business. So that's legal. I mean, this goes without saying, right? If you don't know that, then I don't know where you've been living. Financial side of the business. But there's a third person that you also need to have. Now, depending on where you are in your business journey, either you don't have this person, you are this person, or you have this person working for you. So we're going to discuss these three angles here. So who is this person? This person that either you don't have, you're that person, or you have this person working for you. It's someone who can analyze the operations of a business. Right? So the reason why I say it can be in one of three scenarios. If you are an investor right now and you don't have a team, you're going into a new industry maybe, then you don't know this person who knows how to analyze the operations of the business that you're looking to acquire. So let's say, for example, you've made all of your money in tech. Some people have made a lot of money in tech, but they want to go and diversify and they want to make some investments in different areas. So let's say you've made your money in tech, but you want to invest in healthcare. Let's say, for example, you're going to invest in pharmacies. You're investing in pharmacies. You don't know how to run a pharmacy. You don't know anything about pharmacies. So how do you know? You need to hire an expert who knows about pharmacies. And this expert that you're going to hire, ideally, they also have M&A experience. Now, this is going to be easy in some industries and it's going to be difficult in some industries. In the industry I've just been talking about, pharmacies, healthcare, there are going to be a ton of people who have done M&A, mergers and acquisition activity. There's going to be a lot of people who have bought pharmacies. There's going to be a lot of people who have sold pharmacies. There's going to be a lot of people who have run pharmacies and bought them, or bought them and then run them, and so on and so on. So that's really good. But if you're going into some sort of obscure market, right, some obscure market, then there might not be people there who have M&A experience, but they do have operational experience. They have operational experience. And what do I mean by operational experience? Operational experience means management experience. Yes? Experience. That means management. And when I say management, I don't mean low-level management. I mean on C-suite level. So they need to have been at the CEO or the COO, or maybe director. Director of operations is good as well, because the director of operations will have had close interaction with the COO or the CEO, so that they understand operations at the same level as CEO or COO. The only difference is that they didn't have the ultimate decision that they had to make. Now, to be perfectly honest, when you're in an organization and you're the director, you're probably doing most of the work anyway. When I say most of the work, you're probably doing a lot of decision making anyway. The only thing you're doing is ultimately deferring decisions, or the most important decisions, to your C-suite management. So that's why, someone who has C-suite experience or the director experience, they will be able to do operational, they can come onto your operational team. Now, what you need to do with these guys who are coming onto your team, by the way, I know there's like people out there, they say you have to build a board. And by the way, I have a non-executive board myself, right? That's how I did it. You don't need to have a board. You don't need a chairperson. You don't need a chairman. You don't need an in-house lawyer. If you have a CFO on your team, that's great. And ultimately, you will need a COO to be working for you once you've done a few acquisitions, if you want to be an owner investor. Now, I'm an owner investor, so I don't run I do run my businesses, but I do it really offhand. I have an executive team that does a lot of the management for me. But the ultimate thing is that you need to get someone who knows the operation is going to be running the business for you. But you can't trust people straight away. Now, if you in the previous example I said lawyers and accountants, these guys are firms who are out there just doing one thing, and they're doing acquisitions all the time. So they're in commercial transactions. That's the business that they're in. But your operational person who's going to be doing, your industry expert who's going to be doing your operational due diligence for you, you may want them on your team at some point. But don't give them equity. This is what I'm saying. People are teaching to give these people equity. Don't give them equity. Well, I'm not saying don't give them equity at all, but don't give it straight away. There's a few ways that you can do this. So let's take a look at this. So just say we're talking about industry expert. Okay? Industry expert. So how do you find these people? How do you recruit these people? Now, by the way, with the lawyers and accountants, you find them, they're everywhere. Google search them. Yeah? Google search them. When I was looking for my lawyers and accountants, I found them within 1 week. Yeah? I found my lawyers and accountants within 1 week. By the way, we changed our law firm, but that's besides the point. Our initial law firm in which we got our first acquisition done, within 1 week we found the accountant, we found the lawyer. Saying that, the accountant that I first found, I fired him and I got another one. But that guy we got within the first week. When I say first week, so we found the guy, I realized that the accountant wasn't up to scratch, I should say. And then afterwards, I fired him and I found someone within a week straight away. So the lawyers and accountants are out there. However, your industry expert, you need to be very careful about who you're getting. So number one, LinkedIn is your best friend. Now, I never know how to spell LinkedIn, but LinkedIn is your best friend. You will find no end of professionals who have done what you want to do there. Okay, so there's no end of professionals. Number two, you need to tell them that there's a possible long-term opportunity, but initially we need to see whether we work well together, because they could be an industry expert, but there needs to be some chemistry. When I say chemistry, there needs to be a working relationship, something which is functional, comfortable with that long-term relationship. So the best way to do this, say, look, I'm going to hire you on a fractional basis. Now, if I hire you on a fractional basis, we're going to work together. We're going to complete maybe 2 transactions, and then we'll see if there's a future long term for us. So what does a fractional basis means? That they charge you essentially either by the minute or by the hour. It depends who you get. So the charges are by minute or hour. We'll say charges by hour. It's actually charges by minute, which is, they normally charge you for every 6 minutes, because 6 minutes is 1/10 of an hour, and then it's easy to make charges accordingly. So charges by the hour, and you see whether you can work together. And LinkedIn is where you're going to find them. Now, once you found them, if you found the right guy or the woman, the right girl, then that's great. You don't need to find someone else, because you've got this person who you gel well with. They know what they're doing. They've proven their industry experience through the 1 or 2 transactions that you've done together. And then you can offer them a full-time position. Now, the main thing you need to understand is that equity is more expensive than salary. Salary is cheaper. Now, even though with salary, you're going to be dishing out, 100K, or whatever it is, basically, 100K per year. So you might be like, hold on a second, I'm giving all of my cash away to my industry expert, to my head of operations after two transactions. And I'm only making, for example, 100K myself, but I'm the one who's assuming, all the risk as a founder. I'm the one who's assuming all of the responsibility as a founder, as the one who's the owner. And this guy's earning the same as me. But the thing is that in the long term, so if you offered this person equity, they might be happy working for, 75K or something. Or 60K. I doubt 60K, but I'm just putting there, just for illustration purposes, that if you hand out equity, then people are sometimes willing to take a discount on their salary, because that they know is that either come in the future, or whether it's, for example, the time for an exit. If your plan is to exit, then they're going to make more money anyway. That's why they're willing to take a little bit of a discount on their salary. But it's cheaper to pay the 100K. For example, let's say you pay someone 100K for 7 years, that's 700,000. But then in 7 years' time, you have an exit, and you gave that person 10% equity, and the exit was worth 2.5 million. Meaning the 10% was worth 2.5 million because you exited for 25 million. Now all of a sudden you've just paid this person like so much more money, even though it was at the end, right? So salaries are cheaper than equity. So start off on a fractional basis, right? And then afterwards offer them salary as fast as you can. And if you do want to offer equity, because there is a time for equity, get them to pay for it or get them on a vesting schedule. So either they pay for equity, just like you have. And you can be fair. I paid, let's just say you paid 100,000 per share. After, through the acquisitions that you're doing, it works out that you end up paying 100,000 per share. You get them, if they want 5% equity, they have to pay 500,000. Right, simple as. You're buying the equity at the same price that I bought it. That's what you're saying to them. So either they pay for equity, or you can get them on a vesting schedule. So a vesting schedule means is that there's many, probably not the right time to go into too much detail about vesting schedules, but put it this way, it's either time-based or milestone-based. So it could be, for example, if you work here for 5 years, then I'll give you 2%. And if you work here for another 3 years, I'll give you another 2%. If you work here for another 3 years, I'll give you another 2%. So then over, whatever that worked out to be, 11 years, they earn 6% equity. That's time-based. Milestone-based means, for example, after we've done 5 transactions and you've done all of the operational diligence, then I give you 5% after 5 transactions, 1% per transaction, for argument's sake. So there's many ways in that you can work this vesting schedule out. The best is, however, if they pay for the equity. I made the mistake of going for giving free equity, right? But that's a mistake that I'm never going to make in my life. Again, I would rather get people to pay for equity. So this industry expert, they are tasked with one thing, or they're tasked with multiple things. And now, by the way, the industry expert, or you, if you're a business owner right now, you're the industry expert. But you should be able to analyze things from the top down level. People, they think that they are true industry experts, but they're probably not. And I say that you need at least 20 years experience. 20 years experience. If you're only an operator. As an operator, if you're only an operator. But if you're actually someone who analyzes businesses from the perspective of mergers and acquisitions, then you can get away with, just maybe 3 to 5 years of experience. Years experience. Now, I'm going to give you an example. If you have a teacher at school, a teacher knows how to teach. There's no issue with that. So this is you're an operator, and that's the same example as a teacher. But what about the people who train the teachers themselves? They need to know not only how to teach, but also how to train the teachers as well. And that's what the industry expert who has M&A experience is. They're the trainer of operators. They will be able to spot things that no one else can spot. Just to give an example, in my industry, the person who is the and by the way, they're not the director of operations, they're the director of one of our departments, but it's a key department in our business. Now, they have, they have 25 years experience in the industry, and they have done multiple train the trainer courses, and they have been a trainer themselves for, I can't remember, it's so funny, I don't even know how long exactly. Let's say it's 5 years. It may be 3 years, let's say it's 5 years. So it's 5 years experience, and that's why she is able to go in. So if I want one of the businesses to be analysed, I say, right, Justine, go there and analyse this business. And then she'll go there, she'll have her pen and paper. She's old school, pen and paper. So she'll have a pen and paper, she'll do whatever she needs to do, and then come back and say, right, this is what I've seen. And she'll be completely honest. Look, there's no point beating around the bush when it comes down to acquisitions. If you're going to get people who can't be honest with you, they're yes men, you need to get rid of them. They're not the right person. A yes man is not the right person. You need to hire people who are filling your skill gaps. Yes, filling your skill gaps. It's like, I'm very good at mergers and acquisitions. I know that, right? But I have no idea. I'm not a lawyer. So that's why I hire lawyers. And I'm in the hair and beauty industry for the acquisitions that I do. So Justine's a hair expert, and I've got someone who's a beauty expert. They analyze those operations. But I'm able to quickly see whether an acquisition is actually a viable acquisition or not, because I can see it from the lens of what is this business going to look like post-acquisition? After I get the information from my two executives, then I immediately know whether it's a go or a no. Like, what's the day yesterday? Yeah, yesterday in the morning we had a meeting. Within 5 minutes of my industry expert asking the owner a question, we knew it wasn't the right deal. And we ended the meeting. So we saved ourselves so much time because we asked the right questions. And that's what your industry expert is tasked to do, to go in and to see whether this business is going to be successful after the acquisition has been completed. So this is the experience that they need. And what do we mean by after the acquisition has been completed? Now, generally speaking, you're going to want the old owner to exit the business as soon as possible. There are exceptions to that. There are a lot of exceptions, but of course we can't go through everything in this video. Let's say that the old owner is exiting immediately. So, is that business going to be able to operate without the owner? What is it going to look like? How many people do we need to hire? How many hires? How many promotions? Meaning promoting existing staff members. Is it even viable? Will it continue to generate the revenue? Will it continue to grow? Or will it decline? These are all of the things that your industry expert needs to check. And of course, it goes without saying that your lawyer needs to check that this business is a business which is registered properly, and the person who says they own it obviously owns it, and the accountant is checking the quality of earnings, whether what they're telling you the business is making is making it. So that's what your lawyer, accountant, and industry expert are going to do. So industry expert, lawyer, and accountant. And like I said, you could be the industry expert, or your business is currently large enough that you've got operators under you. If you've got operators under you, just select them like I have. Right, this person is the right person to go and analyze that. This person is the best person to go and analyze that. And I send them out and they do analysis, and I do other analysis, and then we all sit down on a round table, meaning on a round Zoom or a video call, and we decide whether it's a viable transaction. If it is, we push ahead. If it isn't, we kill it there. Save brain energy. And remember, hire in your skill gap. If you are the owner of a successful business, then you could be the industry expert. By the way, you're going to save yourself a bunch of money if you are going to do operational diligence yourself. But you need to know how to do it properly. This video is only about building the deal team, about finding the lawyer, finding the accountant. They're all available on Google. Industry expert normally through LinkedIn, or you could be the industry expert, or an industry expert works for you. And that's how you find them, that's how you recruit them, pay them fees, salary, don't pay them equity. And finally, if you want to pay them equity because they're asking for it and they're really motivated and you really like them and they've done 2 transactions and you work well together, get them to either pay for it or get them on a vesting schedule. That's all you need to know about how to build a deal team. If you want to find out more about mergers and acquisitions, how to do acquisitions, how to build enterprise value and exits, then continue watching the videos on the channel, and I'll see you in the next video.